Go ahead and get started. Good afternoon, everyone. I'm Reena Agarwal, Vice Provost for Faculty at Georgetown University and Director of the Georgetown Center for Financial Markets and Policy. It's wonderful to see how this global virtual FinTech seminar series has continued and the amount of interest in it. Today we have a very special kind of a talk. We have Itay Goldstein from Wharton, and the title of his talk is Financial Market Information and Corporate Finance, an overview with new perspectives for the FinTech revolution. And he's going to present his views regarding the future of FinTech finance research in general, but really related to FinTech. So this should be a very interesting presentation, a little bit different from the typical paper presentations that we've done in the last few weeks. And as we go forward, we're going to kind of mix things up a little bit and try different formats that are more suitable for different kinds of presentations. So as most of you know, Professor Goldstein is the Joel S. Erdkranz Family Professor, Professor of Finance, Professor of Economics, and also coordinator of the PhD program at the Wharton School. He has been the executive editor of RFS since 2018. His research interests include financial crisis, corporate finance, financial institutions, and financial markets with a focus on feedback effects between firms and financial markets. The recordings of all our previous seminars, they're available on our website. Please feel free to visit our website and also follow our Twitter handle at GUFinPolicy. We are most grateful to our sponsors and partners for supporting the center, and we're able to continue with this seminar series, partly because of their help. And I am going to turn this off to Itay. And again, as we've done in the past, feel free to raise your hand and ask questions as we go along. Use the chat feature. Or Itay, do you prefer?
No, actually, at the end. So let's keep the questions all at the end.
Sounds good. So this time around, we'll keep the questions for the end. And you can use the raise your hand feature, the chat feature, whatever you like. And I'm going to hand it over to Itay and we'll get started. Thank you.
Okay, thank you very much. Do you see my slides?
No, share the screen.
No, okay. I didn't see, yeah, right. I think now it should be okay.
No, it's fine, perfect, yeah.
Yeah. Let me get out of this. Fit now?
Yeah, that's perfect.
Yeah, okay. Very good. And you hear me fine, right?
Yeah, perfectly.
Yes. Okay. Thank you very much. It's a pleasure to be here virtually and to give this talk. When Alberto and Reena invited me to do that, basically what they suggested is that I give a general talk around the theme that I've been working on for years, which is the feedback effect between financial markets and corporate finance, and then link it to FinTech. And I thought that's a good idea. This is something I've been working on and thinking about for a long time. And it's also something that I've been giving talks recently. And it is related to FinTech. So the way that I will structure it today is I will give you an overview that is based on one of the recent talks that I've given in this area. And then towards the end, I will tell you how I think some of these issues are affected by FinTech. And I will say, you know, FinTech is obviously a very broad definition. It includes many things. The aspect of FinTech that I'm going to focus on is information, the way that fintech creates new sources of information, broader availability of information, better processing of information. And there is some really interesting work recently on how these things are affecting the dynamics between financial markets and corporate finance. And I will leave that to the end. Okay. So the outline that I'm going to follow, I'll talk in the beginning in general, how I think about the interaction between corporate finance and financial markets. I will tell you that I think a very important aspect, if not the most important aspect of this interaction, is the information that is conveyed by prices and how it affects decision makers in the real side of the economy that affect corporate decisions. I will focus a lot on how managers respond to information in financial markets, but I will very briefly broaden the scope and tell you it's not just about managers, it's also other decision makers, other markets. This is really a broad phenomenon. I will then talk about how this, I think, creates a new paradigm for thinking about financial markets, what I think of as the feedback loop, whereby information in financial markets affect the real economy at the same time that financial markets are reflecting what's going on in the real economy. And I will briefly talk about some of the theoretical implications that are coming out of this. And then I will tie it to the fintech revolution. And using some of the insights that I developed in the beginning, I will tell you what I think we need to look for when we are evaluating the way that financial technology and the vast information that is becoming available because of the financial technology, how this is affecting financial markets and corporate finance. Okay, so let me get started with the interaction between corporate finance and financial markets. And as I mentioned, this is something that I've been thinking about for many years and something that has motivated my research for many years. And there are many people who are thinking about it, not just in academia, but also in practice. And this was always a good inspiration to draw on. One is a quote from George Soros, and he's been someone who has been promoting this view for a long time. And for example, here he says, in certain circumstances, financial markets can affect the so-called fundamentals which they are supposed to reflect. Basically saying that when we think about financial markets, we have to think not only how they reflect what's going on in the real side of the economy, but also how the dynamics in the financial market affect what's going on in the real side of the economy. And this is really an important connection between corporate finance and financial markets. You know, when we think about corporate finance, we think about the real side of the economy. Firms raise capital, invest, employ, produce, provide services. This is the real economy. When we think about financial markets, we think about traders who trade securities, prices are formed. And if you think about the basic paradigm in finance, financial markets, according to this paradigm, are supposed to reflect the fundamentals in the real economy. The key question is, why do we see them not only reflecting the fundamentals in the real economy, but also affecting the real economy? And there are different views on that. One prominent view that has been promoted by behavioral literature, I mentioned here a survey by Baker from 2009, relies on some source of irrationality in this connection between financial markets and the real economy. And the general story there goes as follows: market prices move for some non-fundamental reasons. Because of limited to arbitrage, there is limited capacity to bring prices back to fundamentals, and that implies that mispricing is not easily corrected. According to this view, then, opportunistic managers are going to take advantage of mispricing, and it ends up affecting their capital issuance and possibly other decisions. And as a result of this, shocks in the financial market end up affecting the real economy. Okay, this is really a big literature. I think that there is certainly a lot to this view, but from the very beginning, what bothered me is that I think there are two very important omissions or limitations in this story. And one is that this really only applies to primary financial markets, not to secondary financial markets. The definition, in my view, of a primary financial market is when there is new capital issuance. Okay, so all this story here goes as follows. There is mispricing, you're going to take advantage of it and issue new capital. However, it doesn't really apply to secondary financial markets. When there is just trading, prices go up and down, but no active issuance of capital, no active move of capital from the market to the firm, if you want. And if you think about it, you know, primary financial markets are obviously important, but really the vast activity that is happening in financial markets is happening in secondary markets, where there is not necessarily capital flowing, but still prices are moving up and down, and they seem to have an effect. People pay a lot of attention to them, and they seem to have an effect. So that's one aspect that was missing, in my opinion. Another aspect that is missing is, even if you think about primary financial markets, this view can tell us a lot about maybe capital issuance, but it's not so easy to take this to then explain what happens to important real variables such as investment, employment, and production. In other words, if firms want to take advantage of mispricing, they can do that by issuing capital, but it doesn't have to translate to investment and other real variables. So the way I've been thinking about this related phenomenon, and here I mentioned a survey that I wrote in 2012 with Philip Bond and Alex Edmonds that summarizes a lot of this literature. Obviously, up to that point, a lot in this literature has been updated, and a lot of new research came since then. But the way that we thought about it is that the real effect of secondary financial markets relies to a large extent on the informativeness of market prices. The fact that market prices contain important information that can guide decision makers when they make all sorts of decisions, such as investment. Okay. We talk about two possible channels that are going on. We say both of them rely on information in prices. The first, which I've been emphasizing just now, is that decision makers in the real side of the economy learn new information from markets that guides their decisions. So there is something new they see in the market that guides their decisions. The second, which is a bit more subtle, is that compensation contracts for real decision makers are tied to market prices, and this is the way their incentives and ultimately their actions are affected. Okay. We say that this is also a result of information, because really the only reason to base compensation on market prices is that they are informative. So this is the general background. Let me dive a bit deeper into what I think of as learning from prices. Who learn from prices? Why do they learn from prices? What kind of information are they looking for in prices? What kind of empirical evidence we have to support this view? So the basic idea behind the informativeness of prices goes back at least to Hayek in 1945, basically saying that prices are key sources of information for guiding production and allocation decisions. He talks about prices in general, not necessarily financial market prices, but the arguments apply very directly to financial market prices. And the basic thought is, you know, prices aggregate information from many different traders. As a result, they can provide a new source of information. Okay. Without this market mechanism, it will be difficult to generate this source of information, to aggregate all these different pieces of information that come together into the price. Okay. Now, it's really just, I think, a small step to say, if prices are containing all this useful information, then this useful information should guide decisions that are made by managers and others. And this is the basic premise behind the feedback effect literature that I will get to in a second. Now, obviously, there is a large debate in financial economics. Are prices informative or not? I picked here two prominent sites that say yes, prices contain a lot of new useful information. If you want, for example, this Wolfer-Zizowicz paper here is a review of a very large literature on prediction markets, basically advocating that prediction markets will be a very useful way to generate information that could be useful to decision makers. Okay. So the feedback effect, again, if there is a lot of information in market prices, it's natural to expect that decision makers in the real side of the economy are going to make use of this information in their decisions. Okay. When you think about what prices may be useful, usually we think about stock prices, but it's really beyond just stock prices. It's also futures prices, bond prices, depending on the context. When you think about who can learn from prices, you can think about many decision makers who are affected by what's going on in the firm and affect what is going on in the firm. I will talk a lot about managers learning from prices, but it can just as well be creditors, regulators, customers, and employees. Now, it's important to note, as long as there is some information in the price that they don't know, they will be affected by market prices and by what they infer out of market prices. Okay, so the usual argument against managers learning from market prices is, look, managers know so much about their own firms. Why should they learn from prices? And what I will argue is, yes, they know a lot. Probably the manager knows more than any other single individual out there. However, what is important to note is, even though they know a lot, there is still a lot that they could potentially learn. Okay, there are some dimensions involving, I would say, soft information, strategic analysis, trying to understand market trends, demand for the firm product, and so on which managers don't have really that precise information, and they can benefit from the aggregation of views that is coming from the market. Okay. So much of the literature focuses on managers learning from stock prices. I will talk a little bit about this now, but then I will also briefly mention how the scope can be expanded to include other agents learning from market prices. Okay. Another quote, Farmer and Miller, 1972, basically telling us, an efficient market has a very desirable feature. In particular, at any point in time, market prices of securities provide accurate signals for resource allocation. That is, firms can make production, investment decisions, and so on. So really, the idea has been accepted, I would say, early on, that we care about information in prices to a large extent because we think the information in prices can affect important real decisions. Okay. If you look for anecdotes, I think there are many anecdotes you can think of. One that I've been using from the context of mergers and acquisitions, an attempted acquisition of Quaker Oats by Coca-Cola back in 2000. The announcement of it sent the market down 8% and then 2% the next day. Then there was a meeting of the Coca-Cola board that decided to reject the acquisition following the market response. Now, they would not say explicitly they did it because of the market, but a lot of the commentary around the time suggested that they were affected by the market reaction. A bit of a different dynamics, but also pointing to the effect of a price on an acquisition decision is the HP acquisition of Compaq around the same time, slightly later. Okay, I will say in general, mergers and acquisitions have been a very good place to think about learning from market prices. Because if you think about an acquisition, it is a very well-defined event. It is very clear what you're going to do, and market is focusing attention on it, and then managers can take the reaction in the market to learn something about what the market thinks the prospects are and affect their decision. This has been one of the settings where empirical evidence has been found for the presence of this feedback. Okay, so these are just general anecdotes. Recently we did something very interesting, which is survey. Lian Yang, my long-time co-author, brought it to my attention, and then we collaborated with people in China to basically go and ask CEOs of Chinese firms, what do they think about market prices and in what way market prices affect them. One really nice thing about this setting is the response rate, which is close to 100%. Basically, this is a survey that is conducted in China on a regular basis on different issues, and we use the opportunity to include questions about information in financial markets and the way that they affect firms. The response is really strong and suggesting that CEOs of Chinese firms care about market prices and think that there is important information in them. So for example, here in this question, a vast majority, 84%, say that they care about the price of their own firm, and they also care about the price of other similar firms. Okay. When you go into details to ask them, why do you care about the price? The first answer here is that the stock price contains information that is new for investment decisions. And you see a vast majority say that this is true, that they rely on stock prices because they think there is some information there that is relevant for investment decisions. Not so many point to the compensation channel as an important channel. More say that they care about it because they need to raise capital. This is, I would say, the primary market channel, but still, the secondary market channel appears stronger. And then other things like pressure from the board or shareholders or merger and acquisition protection receive less traction in the data, in the survey. So this is survey and anecdotes. If you go and look at large-scale data to try to find traces of information in prices affecting corporate decisions, there's obviously a challenge. A naive way to go at it would be to say, let's look at whether prices are correlated with corporate investment. Well, obviously they are, but this doesn't say that prices affect corporate investment. Both of them could be high because of fundamentals, right? So the question is to try to tease out from the data whether the high correlation between prices and corporate investment is coming as a result of an active channel of learning. And a lot of the empirical evidence relies on the idea that investment to price sensitivity will be stronger in some cases than others. In particular, when price informativeness is higher, or when we have a reason to believe that there is more information in price, you will expect a higher sensitivity of investment to price. So the majority of papers in the literature looked at something along these lines. And I'm not going to go over them in details. There is a paper by Luo from 2005 that looked at that in the context of mergers and found support for the idea that managers are changing their behavior as a result of information in price. There is a paper that we wrote in 2007 where we looked at general market microstructure measures of price informativeness to show that they are correlated with the sensitivity of investment to price. There are papers by Thierry Foucault and Laurent Frassard looking at cross-listed firms, which are firms that will have more information and as a result exhibit stronger sensitivity of investment to price. And they also looked at learning from peers as another channel to show this feedback effect. And finally, a recent paper by Alex Edmondson and co-authors looking at changes in insider trading laws as shocks to the amount of information available in price, and show that this indeed affects the way that firms conduct their investment. There are also some evidence that are based on mispricing. The idea here is, even if managers are learning from prices, occasionally prices are going to move for non-fundamental reasons and will still affect investment because managers and others are not sure when prices are moving for fundamental versus non-fundamental reasons. Conceptually, this is really the best way to kind of provide clean identification, because the exclusion restriction is more likely to hold. If prices move for non-fundamental reasons and there is no reason for this non-fundamental issue to affect other corporate variables, then showing that there is a response of other corporate variables to the price is kind of a direct evidence of the effect of the price on corporate investment or other corporate variables. I will not go into details here. I will just say that this literature exists. There's some debate on how to measure mispricing and so on, but that's not the focus of my talk today, so I will leave it at this. Okay. So this is about managers learning from prices. I think I should try to go faster so that I get to have a few minutes to talk about Fintech and how it's affecting the dynamics. So let me just say, you know, one can broaden the scope, and that has been done in the literature, to talk about other decision makers learning from prices, including policy makers, regulators, board of directors, credit rating agencies, lenders, and so on. And one can also talk about other types of markets and prices. Most recently, the commodities futures market came into attention because of the potential information that it provides. Let me say a few words about what I would call the feedback loop, and the way that this feedback effect creates a theoretical paradigm for thinking about financial markets and corporate finance. I will highlight here an important insight that has been guiding me for a long time, and I will come back to this insight when I talk about Fintech and how we should think and evaluate Fintech in this context. Okay. So when you think about the implications for theory, again, the main thing I would like to highlight from what I said so far is, you know, prices reflect and affect cash flows at the same time. Traditional models of financial markets, if you go back to Grossman Stiglitz, Kyle, Gloston, Milgram, and so on, do not capture this feedback loop, because they will say, you know, firm cash flows are exogenous. We only care about how the information about these cash flows is going to be processed and aggregated in financial market, but we don't think about how this information then feeds back into the firm. The feedback effect papers will break this paradigm and consider the feedback loop between prices and cash flows. Okay. And in this survey that I mentioned to you in the beginning, that we wrote back in 2012, we highlighted two main groups, I would say, of implications of this feedback loop for theoretical research, but also ultimately for empirical research on financial markets and corporate finance. One that is fairly broad, but most of the papers that have been written on the theory along these lines share this feature, is that usually when you incorporate the feedback effect into models of trading in financial markets, this changes basic predictions on price formation in financial markets. Okay, so in many of these cases, you can take a model of financial markets with no feedback effect, and you derive certain results, and then one will show that when the feedback effect is introduced, those results are changing, and you can give rise to a lot of interesting phenomena in financial markets, like price manipulation or trading frenzies that otherwise would not arise. The second broad insight, and this is the thing that I would like you to keep in mind, and I will take that to my discussion of the fintech literature and how it's affecting financial markets, is when you think about this feedback loop, there are different notions of efficiency that are coming up. We defined it in the paper as forecasting price efficiency, FPE, versus revelatory price efficiency, RPE. The forecasting price efficiency is really to what extent prices can forecast future cash flows. And I think this is really the traditional notion of market efficiency, right? Prices can forecast what will be the future cash flows. However, another notion, which we think is more important, but has been broadly neglected in the literature, is the revelatory price efficiency, RPE. And this is the extent to which prices reveal information that is useful to decision makers and can improve the efficiency of decisions that are made by decision makers in the real side of the economy. If you want, you can call it real efficiency. Now you will say, okay, market efficiency, real efficiency, they're probably always aligned. But one of the interesting insights that is coming out of this literature is that no, they're not always aligned. And in fact, there are cases where market efficiency comes into conflict with real efficiency. Okay, let me give you a very brief example. Suppose that there are two dimensions of information, and one of them the manager is already knows pretty well. The other one the manager doesn't know so well, but is trying to learn from the market. If the market is focusing on what the manager already knows, you're going to have very nice market efficiency, high market efficiency, FPE. However, that information is completely useless from the point of view of managers because the market already tells them what they know. So in some sense, what you care is not that the market can predict what will happen. Rather, what you care is that the market will provide the kind of information that is missing and that could increase the efficiency of real investment decisions. And when I come to the fintech point, I will highlight this as something that I think is important to keep in mind. Okay. So I talk here about a few of the theoretical papers and the insights that they derive. I'm going to skip this because I think I have only 5 minutes before questions. So I want to now devote this next 5 or 6 minutes to talk about the fintech revolution and how I think it is related to what I just discussed. Okay, fintech. So what is fintech? Obviously, fintech is a broad phenomenon, broad definition, including new technologies in different parts of the financial sector. I'm going to focus on one dimension of fintech, which I think is very important. You know, when we did the fintech initiative at the RFS, we started it in December 2016, leading to a special issue that was published in May of 2019. It was a good chance to get input from the field on what people think fintech is, because, you know, we had a call for proposals. We got a lot of proposals. Analyzing what kind of proposals we got, we could see what is fintech, or at least how is it defined in the field. My interpretation at the end of all this is a big part of fintech is about information. One of the key topics in submissions we received was big data, which is clearly about having more information and greater ability to analyze this information. If you do a word cloud out of all the submissions we received, you know, you will see that obviously fintech tells you a lot about fintech, but that's not surprising. Other words like platform are kind of expected, but you will see that some of the most important words that come up is information, ambiguity, efficiency, liquidity, all of them are related to things that I talked about earlier. Okay, so I want to think about fintech as more access to information and greater ability to analyze the information. So new technologies enable investors in financial markets to rely on a lot more information when they trade. That's the starting point. Existing information can be processed, analyzed, and aggregated much more quickly and effectively. Big data, machine learning are two buzz words that are coming up here. Basically saying, we have new techniques to analyze big data, such as machine learning, and this will make more information available to more people. New sources of information also shed light on dimensions that were previously unknown. For example, real-time information about consumer transactions, satellite images, and so on, provide investors opportunities to gain information into what's going on in the firm in real time. This was not possible before. So the question here is, what are the implications? When you think about the fintech revolution as a revolution that increases the availability of data in financial markets, what are the implications? Obviously, the immediate instinct would be that more information will just be good. It will improve the efficiency of markets and resource allocation. However, based on all that I said so far, I would say that caution is required. First, improvement in market efficiency is not guaranteed. We know from literature that new sources of information can crowd out old sources of information. I will mention here a very nice paper by Dugas and Foucault that basically say that fast, imprecise signals could replace slow but more precise signals. So in some sense, maybe the fact that we have all this availability of fast big data implies that there is less deep thinking going on. The other thing, which has been the highlight of what I said before, is that market efficiency does not automatically translate to real efficiency. And this is something that we have to keep in mind. Like what I mentioned to you before, that was based on a paper that I had with Lian Yang. Suppose that the market focuses on learning what managers already know. Okay, then you can have great market efficiency, but that's not the real efficiency. You want the market to focus on what managers don't know. And there is some nice recent work that is providing some empirical evidence and highlighting the nuances involved. This is very, very selected sample. There are more papers, but some things that kind of caught my attention recently. A paper by Brian Weller that talks about algorithmic trading, how it facilitates the incorporation of existing information into prices, however, reduces the amount of new information available. Okay. A paper by Christina Zhu that came out in our FinTech special issue that basically says that firms that are more affected by the access to new sources of data, such as the consumer transaction or satellite images that I mentioned before, they see an increase in price efficiency and investment efficiency. A recent paper by Farbudi, Maitre, Laura Veldkamp, and Venki basically talks about the fact that the abundance of data contributed to market efficiency, but only in some firms, not in all, only in large growth firms. And a very nice paper by Gao and Huang that looked at an older technology advancement, the introduction of Edgar files that made available financial reports to a large audience of investors, and they say it brings more informed trading and improves price efficiency. In current work that I'm doing, we actually look a bit deeper into this to look at the implications for real efficiency, which is what I emphasized before was an important dimension to look at, in my opinion. And we say that here the implications are less clear because the sensitivity of investment to price actually appears to have decreased as a result of these changes. So let me conclude. A couple minutes late, so let me do it quick. So what are the takeaways? What are the future directions? I think all these papers and others demonstrate the complexities involved with newly introduced technologies. I think the tensions that I highlighted above, potential for crowding out and the tension between market and real efficiency, are reflected in this work. In my opinion, there are many more opportunities to do empirical research along these lines, and this is because there are mixed messages. So we need to dig deeper to understand how the different forces compare to each other, which one dominates when, and so on. And also because the abundance of new data sources and experiments, all this data is becoming available, and you can see how the abundance of data affects market prices, market efficiency, real efficiency. There are many opportunities to look into these issues. I would like to end with one concluding thought that hasn't really been explored that much in the literature, but I think is really interesting and something that we want to think about. Everything I described so far has looked into how the fintech revolution is affecting the financial market, and via that affecting corporate efficiency. However, one interesting dimension to think about is, maybe all these new sources of information can replace the market at some point. Maybe the market is going to lose some of the prominence that it had as a source of information, now that there are all these other new venues through which information can be aggregated and conveyed. And I think that is certainly something to think about going forward. So I'll stop here, and I'm happy to take questions.
Thank you so much, Itay, for the great presentation. We already have a number of questions in the chat. If you want to ask questions directly to Itay using, please free to raise your hand. But we actually start from the last question from Davidson Heath. And I think there are two questions there. The first one is, he says that ETFs now account for 30% of equity trading volume. Do you think the rise of passive investing plausibly affects the feedback relationship, and in particular, the forecasting price efficiency and the regulatory price efficiency?
Yes, I think that's a very good question. And indeed, this has been one concern that came up over time, that the rise of passive investing is going to reduce active acquisition of information. As a result, might reduce price efficiency, might also reduce real efficiency. And I think this is certainly something that is going on. There is a recent paper that I remember now by Maureen O'Hara and co-authors that actually says that there is maybe a potentially positive effect also coming out of this that we may want to remember. And this is that the fact that you have all these ETFs could allow traders who want to acquire information on individual firms to hedge more effectively, and as a result encourage them maybe to acquire information. So I think there is this other side to it that we also want to think about. But again, I certainly think this is something interesting to look into going forward.
And then second question, always I think around the similar spin, is Davidson is asking, like, if fintech such as Robinhood brings in new uninformed noise traders, will this make things worse because prices become noisier, or better because informed traders face less adverse selection?
So again, can you repeat what exactly?
So if fintechs, right, like such as Robinhood, bring in new uninformed noise traders, will this make things worse because prices become noisier?
Right.
Or better?
Yes. I think this is an open question. I think when you look at a model, you will probably get a result that says, some amount of uninformed trading is good because it's necessary to keep the incentives of informed traders to trade. Okay, so there could be a trade-off. On the one hand, if you increase the amount of noise too much, prices could become very noisy, but increasing the amount of noise to some extent could make prices more informative. So I think theoretically, there is some tension, and I can see it going in different ways, in different directions, in different ranges and different contexts. And I think ultimately this is an empirical question.
Thank you so much. Let me go to Koz John. Koz, you are unmuted. You can talk.
Hi, Itay.
Hey.
I have this might be something you might have worked on. Let's say I'm a manager with a positive NPV project. I have monopoly access to the project, but I am in a competitive market. Now I want to know how positive is the positive NPV. I can do a private market, let's say market survey, or I can get that information privately, or I can get it from it being reflected in the prices. Now the problem is sometimes when I wait for the prices to reflect that information, I'm also encouraging probably entry into what I'm doing. In other words, I'm diluting my monopoly access to the project, which might have its own real effects. So, are there situations where prices reflecting information is not the best way for resource allocation, because it becomes a different setting? I don't know whether you've worked on. You have a paper on this. I'm sorry if that's the case.
I think that's an interesting idea. No, I don't have a paper that looks into this. I think that's an interesting direction to think about. But basically, what you're saying is, if I rely primarily on the price, which is a public source of information, then I have to take into account that other competitors are also watching and can learn the same information and could act, and then my competitive advantage could be lost to some extent.
Yes.
So maybe what I would like to do is improve the mechanisms that generate my own in-house information, and maybe depress the amount of information that is coming from the market. Is that what you're saying?
That's right. That's right.
Yes.
And yes.
I think that's an interesting thought. And again, I mentioned briefly, an empirical paper by Foucault and Froissart that looks at learning from peers, which they find to be an important channel that is going on in the data. So this is certainly something that is going on, but the question is then, if you are this peer, maybe you would like to make sure that your price is not so informative, so that your competitors are not learning from you.
Yes.
Yeah,
thank you.
I think that's interesting. Certainly an interesting channel.
Okay, perfect. So let me go to another question that comes from Rina Agarwal. She's asking, is the fintech revolution just kind of bringing more information, or in your view, or just an easier availability of information on a central platform? So what is the kind of or is the combination of the two?
Yeah, just to provide a context, right? I'm thinking more from the client side rather than the firm side. And so if you think of, I want to go get a mortgage loan, and there's a platform that makes available what financial institution A is offering, and B is offering, and C is offering in one space. So it's not more information, but for me as a client, it's available in one place, in one platform. So is it just more information? So certainly from the firm's point of view, that intermediary, the platform's point of view, there's more information about clients. But from the client's point of view, that information is out there, but I have easier access to it. It's just like a centralized stock exchange versus fragmented markets.
Right, yes. In my opinion, the fintech revolution really did both. And part of what I meant when I said that, fintech is broad and includes many dimensions, also relates to this. Yes, I think fintech did both. I think that on the one hand, as you say, it created platforms when information can be viewed more easily, and as a result can be acted on more easily. But on the other hand, I do think that an important dimension of it is just the fact that there is also new information that beforehand was not available. So I gave an example of the satellite images or consumer transactions that, beforehand, if you were just an investor in financial market, I don't think this is something that you could easily have access to, and all of a sudden you have those websites and services that are providing this information on a regular basis. So in my opinion, it's both, and I don't really know how to tell which one is more important. I'm not even sure we can say that one is more important. I think both of them play a role.
Perfect. Thank you, Sen. We have a question from Suresh, which maybe he's writing a paper on this, but he's asking, what is your take on using Google Trend data being used for understanding various financial market, asset pricing, and corporate finance questions?
So you say looking at a particular aspect of financial markets and then using Google Trends to see how important that has been over time?
I think so. I'm not sure, but yeah, I think that's what he meant. Yeah.
Yes. Okay. Yes, certainly. I certainly, there are empirical papers, as you probably all know, that looked into related things. And I think that by and large, they show that this is certainly a meaningful indicator to look at for a bunch of things. Now, as another source of information for investors, yes, certainly I think this is something that investors can use, although it is maybe not the most up-to-date thing that you have, because in some sense, when you see that something is going up in the trend, it's already after many market participants, many players have already thought about it and looked for information on it. So it's not the most proactive thing that you can do, but certainly some kind of information.
Okay, our next question comes from Francesco Da Junto. Let me unmute you, Francesco. You can speak now.
Yeah, thank you very much, Itay, for the great insightful talk. So I have a question just to follow up on what Rina was asking earlier. So in a sense, well, mainly we have focused the discussion in the talk on sort of gathering information and reacting strategically by firms in financial markets. But one way in which, at least appears to me, the fintech revolution might really change access to information is also on the retail side, and especially in terms of household finance and consumption choices. So very kind of small individuals that earlier research finds often don't have any access to any type of information for this type of important consumption saving decisions. And so one way, and something I wanted to ask about what you might think about it, is that, of course, we know over the last couple of decades, there's been like this kind of big controversy somehow in camps between kind of behavioral explanations and rational inattention explanations of why some of these non-expert households make decisions that appear like mistakes exposed. So my impression would be that given that the rational inattention stories mainly focus on the fact that for many of these households, even understanding, interpreting, or elaborating information into some kind of prescriptive normative decision they should take is very hard. So we have, for instance, some work with Michael Weber on IQ. We find that until you are really in the very, very top of the IQ, the distribution, many of these households don't even understand what the percentage is. they cannot interpret, even if we tell them numbers or what that means, literally. But then, I mean, the availability of this information through fintech platforms, especially the fact that this information is provided to households in a way which is very easily and vividly understandable, could it potentially help us do some kind of advancement into this sort of quarrel on whether households behave in a certain way because of rational inattention, because they're not able to gather, or it's too costly for them to gather information, or whether indeed there's some form of psychological or behavioral constraint in their behavior. So in a sense, it seems like this type of plan, if we do observe that households do react meaningfully once information is really provided to them in a vivid way, then probably that would sort of be a new way to sort of revive the rational inattention camp or type of interpretations of these so-called mistakes.
Yes, I think that's true. I think this is an interesting thought for future research. You know, I haven't, in my own research, I haven't really looked much into households. Most of what I've done is related to corporate finance, financial markets, financial institutions. But certainly there is a very large fraction of the research these days that is going in the direction of households, and you've done work on this. And I think that exploring those ideas, how households respond to information, given that nowadays we have a lot more sources of information that is available to them, I think this is certainly a very nice thing to think about going forward. And I think that, you know, you're right that certainly something that has to guide you when thinking in those directions is to keep in mind what you think and what you can learn about the sophistication of households, their ability to process the data, to learn from the data. You know, I think you mentioned limited attention, you mentioned behavioral biases. I think, you know, to some extent, maybe there is also some element of sophistication that is kind of related, but also a bit separate. It could be that there is a lot of information that is made available, but only some participants can actually understand it and take advantage of it.
Thank you. And actually, we are almost out of time, but I have a question for you. And this is kind of more for the young researchers here. So we know that many of these fintech platforms or fintech apps are allowing us to getting an incredible amount of information regarding their users. So how people make decisions, how they acquire information. But in many cases, the decision to sign up for these platforms or apps are voluntary. So it's sometimes not very obvious that these populations are going to be necessarily representative. So as an editor, what is your view regarding this point, and what is your kind of suggestion that you may have for young researchers doing their PhD dissertation, maybe working with apps?
Yes. Okay, so you're basically saying that there is some selection bias that
there could be, or maybe not, but yeah. But it's not necessarily a random sample of the population.
Right. Yes. I mean, I think this is definitely something you need to take into account when analyzing the data. You know, I would say a caveat and trying to alleviate the concerns that are coming up in terms of interpretation and so on as much as possible. You know, it's not very different from other contexts and other data sets that people are using, in the sense that you often find yourself with some kind of non-random sample for one reason or another. So I think it's definitely something that has to be taken into account in interpreting the results.
Okay, and then I think we have one last question, and then we can close it up. This comes from Zun Liu, and he's asking, from the perspective of firms, how do you know if there is any evidence of companies using fintech and making it useful for themselves. So examples of research where people have shown that fintech has been useful in helping companies making better decisions.
Yes, yeah, good question. I don't know such research, or at least I can't think of it on top of my head right now. But I do think it's an interesting thing to think about. You know, when you talk to corporate managers, people in the field, everyone is intrigued by fintech, and I think many of them are just starting to kind of think about it and see how they can potentially use it for their own benefit. And I think this is an increasing trend. I think you see more of it now, and you will continue to see more of it in the future, of course, assuming that the current crisis is not changing everything. So definitely that would be something interesting to think about. I'm not sure, you know, if you think about data availability for that, I don't know. I don't know any source of information that will tell you who is using fintech and how. But you can certainly imagine that many firms can benefit for their own decision processes, can benefit from things like big data, machine learning, things like that. And certainly, I think many of them are beginning to think about it.
Perfect. Thank you so much. Let me thank Itay for the wonderful and great and inspiring presentation. I'd like to remind everybody that we will not have a seminar next week because of the WFA. We will resume on Friday, June 26th. We're going to have a slightly different format. So we're going to have 3 papers presented over 90 minutes. And every Friday, we will have a different topic. So we will start with cryptocurrency related research. So we're going to call the first day Crypto Day. And we hope to see you there. Once again, please follow us, all our initiatives of the center. You can follow us on the website as well on Twitter at GU FinPolicy. Have a wonderful weekend, and thank you so much, Itay, again.
Thank you very much.